Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So as far as examples of volatility changes, we wanted to show you this that I suspect, again, most of you who have traded actively are pretty familiar with. What we did was, in the middle of the page, we took, so in other words, right here, we took a look at volatility for whether it's a stock, an option, or rather whether it's a stock or an index or an FX option. And we said if the volatility was at 30 and an at-the-money call was pricing at $4.50, if we were to boost the volatility 10 points, say, to 40, that would make those options significantly fatter because there's going to be a wider price movement described by a 40 volatility than is projected by that 30 volatility. So obviously you can see it's about $1.20 more in premium. And that's one of the, of course, problems or some of the traps that people fall into when they're trading options is that volatility spikes and they just buy a call naked and the stock continues to move or the FX option moves in the direction that they'd predicted. But because they bought an option that was so pumped up, the volatility itself gave the seller of the option much more wiggle room and much more comfort in terms of being able to withstand that move before it goes in the money. And therefore, the volatility of that option means the odds were stacked against you if you were a buyer. And that is the time when we get those volatility spikes, which is what we've pretty much got right now, that I want to take advantage of high volatility by doing a host of strategies that take advantage of high volatility. Conversely, when the volatility drops and falls down here into this $20 or 20 vol level for the same at-the-money call, the option would lose about $1.50 of its value. So it's not providing, if you were a covered writer, it's not providing nearly the same downside protection because again, at a 30, it's providing you $4.50 worth of covered right protection, you being a stock owner and you've written these calls against it. If you wrote it when the volatility is at 20, it's only protecting you for 3 points worth of movement rather than 450. And again, that's why I'm a much bigger buyer of volatility when the options are cheap and a much bigger seller of volatility when it's high. It might sound like, oh, that's just so easy for you to say, Doc, but that is exactly how I trade them and exactly how you can trade them because we have that opportunity. Most programs that price options are going to give you a range of where implied volatilities have been over the last week, 10 days, 2 months, 2 years. And you could see that volatility, for instance, in that particular option class was at a high level or was at a relatively low level. Again, they're at the low level. I'm going to do a different group of strategies when volatility is low than those strategies that I'm going to describe today when I believe volatility is high. Taking a look at this for a moment, this is, of course, the euro dollar. So this is the ISE option for the euro. And you see it here on the slide. You see the graph of where it's come from down here in June of this past year when it was, I guess I can use a different color for that to make it show up better on there. Oh, that didn't work so well either. Maybe I need to use white or something. Let's see. Sorry, those colors aren't working out so swell for me. But you see the place, folks, right there in June and July when the contract is trading at 64, and then you note this big run that it's had running up here towards 80, trading 77.33. I mean, significant pop to the upside, especially since these are foreign currencies. They have strikes, as you'll see on the next slide. They have strikes every point or every half point, and in this case, the EUI has strike prices for January that go 76, 76.50, 77, 77.50, and so on. So we're talking half-point moves, and yet we've had a dramatic move of 14 points from this area, from 64 up here to 78. We've had, 14 full points, so forget about these little half-point moves. Up here on the top of the screen, I'll also point out for you that, let me see, here we go, that we've got both this, and these are right from the ICE, from the International Securities Exchange site. They've got that implied volatility, the mean, and you can see that it's nearly 20. It was down, these are from yesterday, it was down about 2.8% to just under 20. And then look at that range. It had been as low in the last 52 weeks as single digits at just under 8 for the implied volatility of that index. And then you see the highs, of course, at 29. So still way up on the upper end of the band, but not at the highs at all. Then you see the historic volatility, and you see, again, single digit is the low for historic volatility, and the 52-week high at 22, and look at where it is at right now at 2160 on the screen. So pretty dramatic move to the upside, and you see that historically it's still trading at very, very high levels, but that the marketplace is already pricing in that the volatility is coming in rather significantly, because again, yesterday as an example, it was 280. It was down 2.8% when I did that slide. I'll pull up some others over here and see where it was today, but dramatic moves for the EUI, something that doesn't often have such dramatic moves. Just looking at where it is today, I'd say vol has definitely continued to come in the EUI. So with that said, here we've got the EUI trading at 77.41, and we've got both at the money and in the money calls. 77s would be just in the money. 77.5s would be just out of the money. And again, they have strikes every half point. So I'm going to flip onto this next screen. There we go. And one of the nice things that over at Trade Monster that our screens do is they actually give you a net price. So when you're looking at the screen there, the covered calls, for instance, at that 77.5 strike, we can see that the net price that I'd be paying 75.11, that's taking into account that it's paying 77 for the stock and selling the covered call against it for a net of 75.11. And you can see if you did the opposite what the higher end of that would be right over here on this side. So just depending on which way you want to look at it, in fact, with our software, whatever you click on, whether it's a covered right or whether it's a condor or a vertical spread or whatever, it would price that accordingly as you went through that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.